with the question of inheritance tax, or IHT. And I put up there the very basic formula for calculating the IHT. You need the value of the assets, and I'll get to how you do that in a short while. You take off the gross value of the assets deductions, such as debts and allowable expenses. You also take off allowances, and actually there are quite a number of allowances, but I've given you the chief one there, which is nil rate band, and something else called the residential nil rate band. After you've made those deductions, you end up with the net value of the estate, and the inheritance tax will be 40% of that net value. If tax, it's an important point, because what happens then depends on the net value of the estate. If tax is payable, you need one form, the IHT 400, and the tax has to be paid before you get your grant. So you need to liaise with Her Majesty's Revenue and Customs, pay them the tax. They then tell the probate registry that they've got the tax, and the probate registry will issue the grant. If there is no tax payable, it's much more straightforward. You use a separate form, much simpler and straightforward, called the IHT 205, which you send to the probate registry direct, and they will issue the grant to you. So it's a simpler and more straightforward process. So assets, you need to get all the papers together of the deceased and go through them and organize it. So you can write to the various bodies and find out the value of your estate, or deceased estate. And in order to do that, you need, first of all, in most estates, the big one is the value of the house. You can find out the value. Obviously, you can get the value on the internet quite readily. If it's a large estate, I wouldn't recommend relying on the internet. You need to get valuations from estate agents, and you can get 2 or 3. You have to be aware of the fact that the estate agents will charge for those valuations. But above all, you must be realistic. The Inland Revenue will know the average prices of houses in your area, and just putting down a lower value deliberately to avoid tax won't work. You'll only get in trouble. Or difficulty anyway. Other assets I've listed there: money, property stroke land, personal belongings such as jewellery, furniture, cars, shares, trusts, pensions, life insurance, jointly owned property, anything really which belongs to the deceased has potential value. For estates up to £200,000, guesstimates will be accepted, but again, I need to stress, you must be realistic. HMR can check, they can count spot checks, and which means they can be entirely random, and if they find you out, they can charge a penalty and interest. So I can't repeat enough. Be careful, be realistic, that's what I'm trying to say. For all those items like accounts, you need to write accounts, shares, pension funds, insurance companies. You need to write to each asset holder and request a valuation. And I do have template letters which I've prepared, which accompany this webinar, which you can use. You will need items like the date of death, and you'll need to include a copy of the death certificate with those template letters. And I put a point there at the very bottom about a spreadsheet. If you're not technologically minded, then handwritten records, but the important thing is to keep a record of the name of the account holder, the account number, the address, and the amount involved. So that's the assets. Then deductions. Deductions, anything which is owed by the estate. So again, I've listed out there, household bills, bills for services and goods not yet paid, mortgages. You obviously need to write to the lenders in each case, asking for the amount owing on that house or property. loans, debts to families, gambling debts. Gambling debts, provided they're legally enforceable, are a debt owned by the estate. Guarantees, obviously, guarantees a promise to cover someone else's debt if they can't pay it themselves. You may be able to make a deduction in respect of that. Funeral expenses including headstones, the cost of a funeral service, all that is perfectly legitimate expenses which you can deduct from the estate. Debts to close friends, that's where there is a legally enforceable agreement, and there's evidence that the person who's died was making payments. Uncashed checks. If there's an uncashed check, my understanding is that you'll need to check with the bank whether they cover that. The authority to pay paid out on the check may have died with the person who wrote the check. So you need to check with the bank whether they will cover that check before including that as a deduction. If you get a valuation wrong,
which ones do go back to assets or
assets? Really, yeah. If you get a value wrong, you need to report that to the Inland Revenue. If you get it too high, the valuation, then you may be entitled to a refund back from the Inland Revenue for an overpayment of tax. If you've got it too low, again, you need to report it to the Inland Revenue. It's a good idea not to get it too low. The taxman tends to take a poor view of such things, and you may end up paying a fine or penalty. Allowances. This is where the fun starts. Allowances, there's a number, but I'm confining myself to the two major ones, which are the nil rate band and the residential nil rate band. There are others like the annual allowance, the marriage allowance. There's an allowance in respect of business and agricultural property. It would take too long and it's too technical. If you've got any assets like business or agricultural property, it's a specialist area and you will need to consult an accountant or solicitor before going any further. So I'm confining myself to the nil rate band and residential nil rate band. And to be honest, as I said before, these talks are designed for straightforward estates, and those other issues shouldn't be an issue for you. What is the nil rate band? It's a tax-free band. So for a single person, it's £325,000, full stop. In the case of a married couple includes same-sex marriages and civil partnerships. When the first spouse dies, say it's the husband, the wife's estate can claim that tax-free band. So when the wife dies, her estate can claim not just her tax-free band of £325,000, but also his tax-free band of £325,000, making a tax-free band, as I said, of £650,000. And only the amount above that figure is subject to tax. So once the figure goes above £325,000 for a single person, £650,000 for a married couple, the excess is subject to tax at 40%. That's straightforward. So I've forgotten something as well.
Take some.
I think that's it, actually. So that's the nil rate band, which is essentially straightforward enough. Now, the last Conservative government also introduced a further relief called the residential nil rate band, and that is very difficult to explain. But the reason I'm including it is that it's an additional band to the nil rate band, and it goes up by stages. So in 2020, it will have reached its maximum amount, which will be £175,000 for a single person and £350 for a married couple. So that will work out at £500,000 for a single person, £1 million for a married couple. It's not straightforward. It's only available to a married couple or civil partnership. It can only apply where the deceased owned a house which is included in the estate. It doesn't have to be the house you live in. It can be a holiday let. Only direct descendants can benefit, which include children, stepchildren, adopted children, foster children, which is always a bit of a surprise, but it doesn't include parents, siblings, nephews, etc. There's no easy way of going through this. You will have to do a little bit of research if you think you're entitled to a residential nil rate band. But by and large, it's easier if it's straightforward to state to simply stick with the nil rate band. And if your figure comes within those figures, then you don't need to go on to worry about the residential nil rate band because it won't be relevant. But if your figures go above the 325,000 or 650,000 and you think that IHT may be payable, you may still be able to benefit from the residential nil rate band. And that's where you need to expand your inquiries. Right. So just to repeat what I've said before, in order to calculate the tax, you need to get the gross value of the estate, which means you need to go through all the assets, work out the value of those assets, tot it up. If it, then you need to take, that gives you your gross value. Then you deduct the debts and allowable expenses, as I explained before. You deduct the allowances, the nil rate band, and other release. As I said before, the net value is the net estate. You multiply that by 40%, and that gives you the amount of tax. If tax is payable, you need IHT 400. If no tax is payable, use the form IHT 205, which is the form I'll be going through in my next talk. And if tax is payable, as I said, you must pay tax before probate is granted.